Welcome to Outside the Dollar. I'm Elena Reyes. This week, confidence itself is being tested in currencies, in markets, in the economy from a handful of different directions at once. First, we're looking at China's quiet effort to reduce its dependence on the dollar, expanding settlement in its own currency step by step. Then I want to stress test a question that sounds obvious but isn't. Does a healthy economy actually mean a healthy stock market right now? After that, inflation, why one of Europe's top central bankers is warning it isn't finished with us yet. We'll also get into why UBS is staying bullish on gold, even after its recent pullback. And I'll close by asking what all of this means for how you think about diversification in your own portfolio. 5 threads, one underlying question. How much can we trust the system most of our money still runs on? Let's start with China and the slow rewrite of the dollar's role. Every June, bankers and policymakers fly to Shanghai for the Lujiazui Forum, China's version of Davos. And this year, according to a CNBC op-ed published June 28th, the signal coming out of that room wasn't about replacing the dollar, it was something quieter. Reserve currency status just means most countries settle trade and park savings in one currency, by habit, the dollar. That habit took decades to build. It doesn't flip overnight. So what is China actually doing? The CNBC piece argues China isn't trying to dethrone the dollar outright. It's expanding renminbi settlement in trade deals, currency swap lines with trading partners, energy contracts priced outside dollars, piece by piece. Why should someone with a 401k in Ohio care? Because reserve status is what lets the U.S. borrow cheap and run deficits without immediate consequence. Erode that demand slowly, and you erode the machinery underneath everything else. This isn't a headline crash we're talking about. It's a slow reduction of dependence, one swap line and one settlement deal at a time. And CNBC frames it exactly that way, reduced dependence, not sudden dethroning. If confidence in the dollar's dominance is being tested at the currency level, what happens when you look at the confidence baked into stock valuations sitting on top of it? Are markets actually pricing the real economy underneath them, or something else? With that question hanging, let's stress test an assumption a lot of investors carry without checking it. The assumption that a strong economy guarantees a strong stock market. Yahoo Finance ran an analysis on June 29th, written with Reuters, arguing the U.S. economy and the U.S. stock market are starting to move on separate tracks. Think about what that means. GDP can grow, jobs numbers can hold steady, and stock prices can still stall. Why? The piece pointed to 3 pressures: valuations that already stretched, real interest rates sitting at elevated levels, and a wave of AI-driven spending propping up a narrow slice of the market. Lear Capital's research raises the same flag. A chunk of many retirement portfolios now rides on a small handful of AI-linked names. If most of your equity exposure sits in that handful, a healthy economy headline won't shield you from a repricing in that group. A resilient labor market doesn't change the fact that valuations were priced for close to perfect outcomes. When conditions shift even slightly, elevated real rates make any repricing sharper. Uncertainty like that tends to push investors to reassess risk they'd stopped thinking about. The Bundesbank's Joachim Nagel is already flagging pressure on prices, speaking from a central bank forum in Sintra, Portugal. Inflation. With that inflation warning in mind, here's what Nagel actually told CNBC. Speaking to reporter Annette Weisbach at the ECB's forum in Sintra, Portugal, Bundesbank President Joachim Nagel said inflation is at risk of staying, in his words, significantly above target, even with the U.S. and Iran ending their conflict. UBS just raised its 12-month gold target to $5,200 an ounce, according to Investing Live reporting on June 26th. That implies roughly 30% upside from current levels. Now, UBS isn't calling this a sure thing. They're calling the recent dip a buying opportunity, which is a specific claim, not a guarantee. Their case rests on 3 legs. 1, the Fed holds this year, then cuts in 2027. 2, the dollar stays structurally stretched and weakens over time. 3, central bank buying keeps providing a floor under the price. What happens if any one of those legs doesn't hold, if the Fed doesn't cut or cuts less than expected? UBS actually flags that risk themselves. They point to rising real yields and a stronger dollar as headwinds that could pin gold in a near-term range of 3,850 to 4,000. Forecasts are just that. 12 months is a long time, and a lot of banks have missed targets before. Not that gold is destined to hit 5,200, it's that a major bank sees enough structural pressure, rates, dollar, central banks all pointing the same direction to make a public call on it. And it raises the bigger question I keep circling back to. How much of your portfolio is actually diversified versus just concentrated in a few winning bets? That's worth a closer look. Shifting from metals to something closer to home, your 401k, according to Yahoo Finance, a small number of AI-linked companies have driven an outsized share of stock market gains the last couple years. If your retirement account tracks a broad index, you might assume you're spread out. You might not be. Here's what that looks like in practice. Say you hold an S&P 500 index fund. On paper, 500 companies, but market cap weighting means a handful of the biggest names can drive a huge chunk of that fund's movement. If most of those names are chip makers, cloud providers, 1 or 2 software giants riding the same AI story, you're carrying concentration you never chose. Does that make sense? You bought the market. What you may actually own is a bet on a small group of companies executing one expensive thesis. The question is whether valuations ran ahead of earnings and what happens to accounts that look diversified from the outside if that narrow group stumbles. Most people have never run that math. It doesn't show up on a quarterly statement. You have to go look for it. Nobody knows whether this ends smoothly or the way concentrated trades have ended before. Nobody rings a bell on the way down. What you can control is exposure. That's where physical gold and silver have historically been a possible fit, not competing with growth assets, sitting outside the corporate earnings cycle entirely. Gold doesn't issue quarterly guidance. Its record for holding purchasing power runs back centuries, long before this tech cycle started. And before you move real money on anything from this episode, China's currency strategy, a $5,200 gold target, any of it, talk to a financial professional who knows your full picture. Nothing here is investment advice. It's a map. You still need someone who knows your terrain. Markets shift, currencies shift, even gold forecasts shift. The one number worth knowing cold is how much of your future rides on the same handful of bets. So that's the week. China quietly building settlement options outside the dollar, stocks leaning on a handful of AI names, Nagel's inflation warning out of Frankfurt, and UBS still bullish on gold. The common thread? Confidence in one system, one trade, one currency is worth educating yourself on right now. Want Lear Capital's research on gold and silver? Visit learcapital.com or text $$ to 43343 for a free investor kit. Thanks for spending this time with Outside the Dollar. Subscribe, leave a review if this helped you think differently, and I'll see you next week for the next set of stories moving markets, metals, and the dollar.